Good morning, everyone, and welcome to the first in a new series of webinars brought to you by the team at UNTHA UK. My name's Katie and I'm your host for this morning, and I'm delighted to be joined by three extremely knowledgeable speakers who you see on screen here. And together we're going to explore the topic of securing finance, funding and freeing up cash flow. Before we begin, I just need to share some very quick housekeeping advice for each of you. You've all had the choice to tune into audio via your computer or telephone. So if you're experiencing any sound issues at the moment, please consider using the telephone number, access code and PIN provided in your invitation. Likewise, if you are experiencing any lag at any points as we go through the slides, you might just want to close down any other applications or browsers that you've got running in the background, just so that your computer is concentrating only on powering this session. Finally, you'll hopefully have a chat panel on the right hand side of your screen. If you can't see that, just look for a little orange arrow that will open that for you. And this allows you to pose any questions that you might want the speakers to address when the session comes to an end. In terms of what we're going to cover today, I'll quickly tell you who we are joined by on this webinar. We've got Oliver Whitehurst with us, who's a Relationship Director from Barclays Corporate Banking. He's going to be kicking us off by delving into some of the options available, the considerations you may wish to take when evaluating your finance routes, and also how you can work with your bank to safeguard your future. We've then got Liam Given, who's an Area Sales Manager from Close Brothers Asset Finance, and he'll be exploring the options that exist when it comes to financing a new asset, funding a rebuild to optimise existing processes, or freeing up cash flow to use elsewhere within your business. Then we'll close with a short presentation from Marcus Brew, Managing Director at UNTHA UK, who's going to show you how some of these different finance solutions can take shape within your waste and recycling organisations. It's important to stress that this session is not a sales pitch. In fact, the purpose of this webinar and the straight talking webinars that will follow is to cut through some of the scaremongering headlines we've started to see in the industry in recent weeks. We've done a little bit of our own research, and yes, we do know that some organisations are still focusing on survival and they need to get their hands on finance quickly to protect the future of their businesses. But elsewhere, we're hearing multiple reports of operators pressing ahead, innovating, planning for growth, and it's those organisations that require finance to unlock their potential. So whatever the reason for you joining us today, welcome, and we hope you find it useful. One last thing from me, because we realise it is quite a meaty topic for us to cover today. Providing the technology is kind to us, I'm going to be sharing a few questions on screen along the way, and those are short polls for you to participate in yourselves if you feel comfortable in doing so. I'll launch one now so that you can see what I mean. Hopefully you can now all see a question on screen in front of you, and using only your mouse, I would ask you to please answer the question that you see. What's your primary reason for exploring finance at the moment? The votes are coming in. So if there's something obvious that you think applies to you today, please just select that option, and we will use the results from these polls to form the basis of a short discussion at the end of the session. At the end of the presentation, when the three presentations have finished from the speakers you see here, we will also invite you all to post any questions that you have individually, and those questions will be then open to the floor for a further debate. So if you've anything you want to ask as we go along, please type the questions in the questions box and we'll take it from there. I'll close that poll now. Thank you very much. And I'm going to hand control of the webinar over to our first speaker, who is Oliver Whitehurst from Barclays Corporate Banking. Oliver, it's all yours.
Morning, everybody. So thank you for your time this morning. So as Katie explained, I'm Oliver Whitehurst. I'm a Relationship Director within Barclays Bank. So I manage a portfolio of around about 35 SME type businesses in the local area. So yeah, really today what I want to talk to you about is the various different methods of lending which I see common in my world. Of course, there will be more across the banks and all other funders, but there isn't a one-size-fits-all type scenario. So really, just to give you a flavour. So first of all, let's get onto the first slide. So first, I want to talk to you about overdraft funding. So typically, this is used to fund short-term cash flow. So I allow you to make payments while you're awaiting receipts from your customers. So you can use it as well for capital expenditure, and it essentially an overdraft is an on-demand facility. So rather than a term loan, which we'll come on to later, which has a set repayment date, the overdraft is in place, but there isn't a set repayment date. So there is that onus on the business to repay it themselves. You pay interest on what you borrow. So rather than paying an overall interest amount, you're paying on what's actually overdrawn. So as you fluctuate into credit, you're then going to not pay interest, obviously, on the amount that you're in credit. It's only when you're in debit. And usually you pay an arrangement fee for this type of facility, so whether that's annually or quarterly. Typical security, so it does vary by different business, but typically this would be could be secured via a property or based on the strength of the actual business. So when you're looking at taking charge over a business via a debenture charge, then typically in the background as a bank we would look to have the overdraft balance covered by a certain amount of debtors, so we can see that there is that money due back into the business. And really, from a bank's point of view, we want to see an overdraft fluctuating into credit and into debit. So there's not, we call it a hardcore position. So I always overdraw. What that would then indicate is actually is an overdraft the right position if you are always in debit. So then moving on, the next type of funding that I want to touch about is confidential invoice discounting. So in essence, this allows you to make early payment of your, essentially allows you to make early payment for invoices that you've raised. So there's a preset early payment percentage or an EP percentage, which is basically the percentage you are allowed to draw down against the invoice. So it varies industry by industry and business by business, but a typical amount might be 80-85%. So as a business, what you would do is upload either a daily or a weekly total of invoices rather than individual invoices. I think that's quite a common misconception. So you don't have to upload absolutely every invoice, but it's the total. And then the debtor pays the fund into a trust account, which is in your name. So they aren't aware that you have this facility in place. Because historically, there was quite a negative image with invoice discounting and factoring. I think there was really an image around that if a business was using this type of funding, that they were desperate for funds and therefore it's struggling really. Whereas we're seeing across the industry that this is more and more common. Within Barclays, we're slightly different the way that we do it. So we take a charge under Barclays Bank PLC rather than under Barclays Bank invoice discounting. So it is truly confidential. You might also have other restrictions in place under the facility, such as a prime debtor restriction or an export restriction, but it really depends on the ledger book. And typically with this type of funding, you would get a higher level of funding versus an overdraft because it's a more structured type of way of funding. So from a bank's point of view, we know that you've got these invoices and we're funding exactly against that, whereas an overdraft, because we're looking at it on a look back basis to your figures that you provide us, which may be a couple of months out of date, it's more difficult for a bank to control that process, and therefore you usually get a lower limit on an overdraft versus an invoice discounted account. And it's pretty similar to an overdraft in that you pay interest on the drawn amount, which is usually lower than an overdraft, again, the interest rate, and a service charge each month, which in essence is your arrangement fee. So term lending. So term lending can come in a variety of forms, but the traditional type of term lending which can support growth is really looking at commercial mortgages. So I've seen many businesses across my portfolio that have been in rented properties and they're thinking, actually, now is the time to look to purchase a property. So rather than paying somebody else's mortgage, you're paying your own, and at the end you've got obviously the property within your balance sheet, so you're getting that balance sheet growth. Something to consider is loan to value. So it varies across funder across sector and across business, so there are quite a few moving elements. This can vary. So a typical amount might be, say, 70%. So you're going to need 30% deposit from your own funds. And then terms can vary as per a personal commercial mortgage. So you might look at a 15-year mortgage, but because the cost of 15-year money is high, you'd have a shorter committed period. So whether that be 3 years or 5 years, and that allows you a break. So essentially you can repay in part or in full after that period. So term loans as well can be used for capital investments. So really secured against the particular assets, or unsecured, depending on, again, type of business and the use. And as a bank, we would look to put more covenants in place. I suppose the more that you borrow, the more we're going to look to look for more control from a covenant basis. This may be an EBITDA, so earnings before interest, tax, depreciation and amortization against the debt service, or we may look at a cash flow covenant, which essentially tracks cash within the business and looks at working capital and how that moves. We then got trade loans or trade finance, so the bank tries to, rather than just say everybody has an overdraft, everyone have a term loan, we try to look at the business, or a funder tries to look at the business and really tailor what our facilities are to match what a business may need or a particular contract. So trade loans and letters of credit are great examples of this. So it may be that it's a one-off purchase or an ongoing purchase of materials. So with the support of your bank, both trade loans and letter of credit can be used to fund purchases. So it's a way to bridge the gap between when you need to pay for materials and when you're getting paid by the end customer. So sometimes it can take a long time, obviously, to convert that purchase into cash. So the trade loans and trade facilities can help do that. They allow you to offer your supplier the potential for payment at an earlier stage, whilst in the case of a letter of credit, you're still mitigating the risk of non-delivery. And what that allows you essentially to do, so rather than, for example, if somebody's building a machine for you, for argument's sake, and they want a 10% deposit, maybe that you put a trade facility in place and pay them more. So actually they give you a larger discount because they're getting paid more upfront from their point of view. So it helps with their working capital. So, for example, if you get a 5% discount and it's a regular monthly purchase, and over the term of the year, then 30% discount is going to way exceed any bank charges, any bank costs from that perspective. Another example I just wanted to give you was around trade finance working with asset finance. So this really works when, if you're buying a piece of machinery and it's getting built overseas. So typically within Barclays, we couldn't fund that asset finance. We couldn't fund that until it arrives in the UK. So essentially, you can put a trade facility in place, which will allow you to draw down, pay the manufacturer, and then essentially when the asset arrives in the UK, you can refinance it under asset finance. Again, this can be used to help negotiate different discounts with your supplier. And there's different risk mitigations that can be put in place. Really, for security for these types of facilities, it is really based on the strength of your business. So I've seen it both balance sheet led, so i.e. a debenture, so looking at the overall worth of the business, or charged via a particular asset, and then ultimately the asset finance secured against that asset at the end. So just popped in a part around asset finance, but I know Liam's going to talk more in detail around this, but it's just to show that there are different methods of asset finance funding that covered off within that I see in the banking world. And finally, a hot topic obviously now, what's going off, COVID-19 funding. So the three main schemes that there are SIBLs, syllables and bounce back loans. So within my world, I mainly see SIBLs funding. So essentially, this is funding up to £5 million up to 6 years, and it's to fund business critical expenditure that has happened, or the business being impacted due to COVID-19. Funding for businesses up to a turnover of 45 million, and interest rates are on a case-by-case basis, but there's no interest or arrangement fees payable in the first 12 months. And then no early repayment fees. There's capital repayment holidays available up to a year. Really, the way that the bank's testing is that it's a viable business last year, so up to, say, December 2019. And we then overlay whether the loan would be affordable back to the business. From a security point of view, there's no personal guarantees set by the scheme under 250,000, and then different lenders are taking different approaches above that. So within Barclays, we're saying no personal guarantees whatsoever, but above 250,000, the scheme dictates to you that you do have to look at other security, and then the government will provide an 80% guarantee of any losses on that. The syllables loans very similar, but loans are up to 200 million and turnover above 45 million. The terms reduced down to 3 years, and then security has to rank in line with any other security. And the bounce back loans finally are funding up to £50,000, and the government 100% guarantees. Again, no interest or fee in the first 12 months, and there's a 2.5% interest rate applicable. Application process really straightforward. They're mainly done online, and funds are sent to you ASAP. So hopefully within a few days. Now that the real spike at the beginning's got through. So that's everything I really wanted to cover. Really happy to take any questions at the end. It'd be interesting to hear everybody's thoughts and experiences, particularly around type of funding that you've either tried to got, or whether different ways that there are to do it. But thank you very much, everybody, for your time. I really appreciate it, and I'll hand back over to Katie.
Thank you, Oliver. So lots of content covered there at breakneck speed. So if anyone does have any questions off the back of Oliver's presentation, please do type them into the question box, and we will review that chat function at the end and post as many questions to the three speakers as we possibly can. Because questions are a theme for today, if you don't mind, I'd just like to ask you another one, please. And this one is very much on the specific of asset-based lending. Oliver covered it in his presentation very briefly, and our second speaker, Liam, is going to be discussing that in a little more detail shortly. So if you wouldn't just mind, please, answering the question you see on screen, and it gives us a little bit of extra data to facilitate the discussion at the end. I can see a few people have voted so far. So if another few people wouldn't mind just voting, I'll give you a few more seconds, and then I'll hand over control to Liam. The results are coming in now. Thank you very much. Just give you a few more seconds. So have you ever considered asset-based lending before? Yes, no, or would rather not say. Okay, thank you very much. And I'm now going to hand over control of the webinar to Liam. You just bear with me 1 second. Liam, over to you.
Thanks, Katie. So, yeah, hi to everyone that's logged in. Thanks for joining us. I'm Liam Given, and I work for Close Brothers Asset Finance. I work within the waste recycling team. So, in terms of what I'm going to cover off, so firstly, I'll give you a very brief overview of the Close Brothers Group, and in particular, Close Brothers Asset Finance. I'll then move on to the products that are available, break them down a bit further. We'll have a look at the sorts of assets we can fund, and then lastly, I'll move on to the civil scheme and how that ties in with asset finance. So, Close Brothers Group, or Close Brothers PLC, we're a merchant banking group that provide lending, deposit taking, wealth management services, and security trading. So predominantly we're based in the UK. However, we've got branches in Ireland, and we recently opened up a asset finance business in Germany as well. So under the Close Brothers PLC umbrella, there's various businesses, but the one I work in is Close Brothers Asset Finance. So we employ over 500 people, so a very large part of the bank, and we've got various offices around the UK. So Close Assets split into industry-specific divisions. So we've got waste and recycling, manufacturing, transport, construction, and print. So if you know of any businesses that don't fit within the waste and recycling bracket, and you feel they may benefit from what we discussed today, please feel free to pass on my details, and I'll be able to point them in the right direction. So asset finance. So basic idea behind asset finance is to help your business reach the next level without disrupting your cash flow. So The main 4 products we offer are hire purchase, refinancing, finance lease, and operating lease. So there's a few different variations of each, but we'll keep things simple and just have a look at the benefits of each of the 4 products. So first one, probably the most commonly used and simple finance package we offer. So the product basically allows you to spread the cost of the asset over a fixed term. So terms usually between 6 months to 6 years, but it depends on the cost of the asset and what your cash flow will allow on a monthly basis. So in terms of the benefits, you get to keep control if you're the owner of the asset for tax purposes, and you can normally claim capital allowances. Seasonality, so we can structure repayments to take account of seasonal fluctuations in your cash flow. It's tax efficient, so you can offset your hire purchase interest and charges against pre-tax profits. You can reclaim VAT, but most importantly, it's quick, it's easy, and it's simple, really. So refinancing, it's another version of hire purchase, basically. So personally, it's the product I'm most involved with, but it focuses on assets that are listed on your balance sheet, so basically assets that you own. So it allows you to raise a cash injection should you need it for any eventuality, such as management buyouts or purchase of land or site development, anything like that, really. So we can use unencumbered assets as well as assets that are on finance elsewhere, as long as they're in an equity position. So in terms of the benefits for refinancing, so you get all the same benefits as you would with a HP. It's efficient, so you get an uninterrupted use of the asset. So basically, say there's a loading shovel in your yard that we're lending money against, stays exactly where it is and can continue to work. We're able to realise the true value of your assets. So we're used to dealing with this type of kit. Like I said, we work in a waste and recycling division, so we deal with this sort of kit all day. And you can use it in place of deposits or VAT at the start of a hire purchase agreement to avoid large initial outlays. So you can actually combine the 2 products to help you get the asset that you're looking for. So moving on to finance lease, you get the user benefits without the ties of ownership, basically. So these agreements, they let you use the equipment you need without having to buy it outright. So you're effectively renting the asset, but cutting out the middleman by going direct to the supplier. So benefits with this, that's paid monthly, so no large initial outlay again. You can continue to use the asset by entering into a secondary period rental. So that's basically a one-off fee per annum, and it lets you keep the asset for another year. You can sell the asset and keep a portion of the income from the sale, or at the end of the agreement, you can simply just return it to us. So moving on to operating lease. So it's similar to a finance lease, but an operating lease allows you to rent the asset from us whilst you need it. So the key difference between the 2 is that operating lease is only for part of the asset's useful life. So this means that you pay a reduced rental because the cost is based on the difference between the asset's original purchase price and its residual value at the end of the agreement. So a few benefits that come with this one as well. So it can be used in line with a specific contract. So say if you know that you require an UNTHA shredder, for instance, to complete a job over the next 18 months, we can fund it just for that specific period. So there's no burden or responsibility when it comes to disposing of it or recouping its residual value. Low initial outlay, flexible. So there's the option to re-rent, purchase or return the asset at the end of the term. Most importantly, you pay less because the rental cost is reduced as it's based on a percentage of the original capital cost. It's off-balance sheet funding, and you can reclaim the VAT on the rentals. So just moving on to the types of assets we can fund. So typically we'll fund most assets that are used within the waste recycling industry. So a few examples here, you've got recycling plants, shredders obviously, handling equipment, vehicles, and obviously the rest of the assets you can see on this list here. But if there's anything weird and wonderful or bespoke, then please don't hesitate to get in touch. There may be a way to provide the funding you need, whether it's funding the asset direct or through a HP facility, or we can look to raise cash out. So moving on to the hot topic, CBILS. So for those of you who don't know, CBILS or CBILS, however you want to say it, stands for Coronavirus Business Interruption Loan Scheme. So it's provided by the British Business Bank. So they're a development bank that work as a sort of interface between the lenders and the government. They've introduced a few schemes off the back of current situations. Oliver mentioned them in the previous presentation. So like you said, CBILS, bounce back loan, you've got the large business scheme as well. So if you wanted to explore a few different options, it might be worth visiting the British Business Bank website. So I'll put the link up at the end of the presentation. So moving on to how CBILS and asset finance tie in together. So there's a few different forms that a CBILS facility can take dependent on the specific lender. So I believe the British Business Bank didn't want to change the way funders lend money too much. So a couple of reasons for this. They wanted to get the product out to market as quickly as possible, and they wanted the specific funders to stick to what they do best, basically. So with regard to CBILS and asset finance, the scheme's been tailored to 3 of our existing products. So HP, refinance, and finance lease. So in terms of the benefits to an asset finance CBILS facility, the government offers a business interruption payment, so that covers all the fees and interest within the first 12 months. It's quick to turn around. The government backing allows us to increase our loan to value on refinance agreements. It can be used to facilitate new lending as well as restructuring debt. No PGs under 250, as Ollie mentioned, and it allows us to fund bespoke assets as well as assets where installation costs are quite high. And also it doesn't exclude startups or young companies. So moving on, there's a few different questions that we ask at the start of the process just to make sure that you are eligible. You actually use a questionnaire online to fill in, but we can go through that before anyone applies. But so the first one is, has the borrower been affected by the coronavirus? So it's hard to find a business that hasn't at the minute. Does the SME have a viable business proposition? Is the borrower an SME, sole trader or partnership? Does the SME generate more than 50% of turnover through trading activity? Does the business trade in the UK? Was the business in difficulty before December 19? And does the business or group turnover less than 45 million? So pretty straightforward stuff really in terms of the eligibility. But just a couple of points to remember. So the borrower is 100% liable for the debt. It does need to be repaid over time. And the scheme only runs until the 30th of September. Don't know what's going to happen after that. I'm sure it'll depend on the economy and what's happening with the COVID situation. But the information we've been given at the minute is it is only running until 30th of September. But yeah, that concludes my presentation. So feel free to ask me any questions at the end of the presentations, and I'll answer them as best I can. Thank you.
Thank you, Liam. So before we hand over to Marcus for the final presentation of the day, if you wouldn't mind just completing, please, the final poll that I'm going to share on screen with you now. So have you tried to secure extra finance or funding since the outbreak of the coronavirus pandemic? This is the final question we'd like to pose to you, please. So please don't be shy. We don't know who answers the question with what response, but this data will just help us inform some of our conversation at the end. Just give you a few more seconds, fairly neck and neck at the moment. Okay, I'll close the poll in just a few seconds. So if anyone hasn't voted, if you would just select one of the options that you see on screen, that would be much appreciated. Super, I'll close that now. And I'm going to hand over to Marcus Brew, who is the Managing Director of UNTHA UK, and he's going to try and give a little bit of context to some of the advice that Liam and Oliver have shared with us so far. So Marcus, it's over to you.
Morning, everyone. Yeah, thanks for attending today. I know everyone's extremely busy in these times, but yeah, I mean, as Katie said, we just wanted to give a little bit of a flavour today of you know, how funding could be available, what types of funding you know, you could use, not only to purchase shredders or capital equipment, but generally, you know, to help businesses through these difficult times. To put it into context, I just wanted to show what we, through our experience, the things that companies should look for when looking to finance capital purchases, whether that's a shredder or other equipment. So what are the main things? I mean, it's deposits amount. Now, obviously, you know, there seems to be a A lot of the times, people may look at a low deposit situation, might not be the best fit for the business. Obviously, we would work with you on that to ensure that obviously any deposit amounts that you would have would fit with the finance that was available for you. Obviously, this is all underwritten by the banks. We don't have a lot of control in terms of what deposit would be required, but there is ways and means that we can mitigate that for you over time. Also, installation costs, big thing. Obviously, typically, we're transparent in what we do and the information we get out to our customer base, but generally there might be other installation costs that you need to think about. A lot of the times with especially large equipment, they use a lot of power, and putting in electricity supplies or civils can actually cost quite a bit of money in terms of your schemes. It's just something to consider, but also, as the guys have said, there is funding available to ensure that your scheme runs smoothly or your project runs smoothly, and those type of costs can be included with any lending that is agreed at the time. Obviously, your resources. So, we're not just talking about the staff here. Do you need more vehicles? Will you need more equipment to supply the materials to, say, a shredder? And it's, these things as well can be all wrapped up into any lending that is approved at that point. And then look at your running costs as well. I mean, obviously, these typically are quite high cost items to operate. So, it's important that any suppliers that you're talking to are transparent in terms of what these costs will be, because obviously, that will form a huge part of whether the scheme will be successful or not in the long term. So, looking at the finances, obviously this is very high level. We as a business, we've got a lot of experience in this, in these areas. We're dealing with banks and finance companies to ensure that we can provide the information that you need to ensure that any application that you do is successful. Looking at what monthly revenue will the project generate, obviously, we could look at help you there in terms of, as I said before, your throughput, what revenue that you're going to get per ton from the material that you're either going to be selling, or the gate fee that you're going to be taking for that material. And we've got a lot of experience in ensuring that those figures would be correct and would allow you to do those projections in a very, very accurate way. Now, and also, what term would suit your business to achieve best ROI? Again, sometimes stretching out repayments could suit your business. It could be that you're looking for to start to get a return on the investment very, very quickly, and typically, a longer payback period would be suitable. Or it could be that there's some other internal ROI positions that you need to look at, and again, we can reduce the reduce the ROI term and look at the best bit of equipment that would let you achieve that ROI in the required time. And also, again, the guys have touched on this, but do require extra cash to fund the startup and operational costs. One of the things I think people don't realize is that, we are able to fund the actual purchase of spare parts, wear parts over the term of the contract for you. And, this can, there's no big spikes in cash flow by doing things this way. It spreads over the cost of those items over the term, and obviously allows you then to understand where your cash position is going to be on a monthly basis. And as I touched on before, what other equipment do you require? Yeah, it's massively important, that with all these things and with the guys that we actually deal with, Liam and Oliver, it's that we look at the scheme as a whole and ensure that you not only got the cash to purchase UNTHA products, but you've also got cash for the other equipment that you may require. So in terms of operations, so how many hours will you need to operate your equipment over a period? I mean, obviously this would all be around, what contracts that you have, how much material you need to take over the gate typically, and also what throughputs that your plant will need to achieve to ensure that, during that period, you can operate that plant effectively. It might mean that you need to run to 2 shifts or even 3 shifts, within the when you operate the equipment over that time, and we can help you with that. We can provide those figures and allow you to make those judgments and again, create a more accurate business plan. And which will help you the application process with any banks or with the finance companies to ensure that approval comes through quickly. And what additional capacity or other driver is needed to ensure project success? So again, coming back to throughput, how much material do you need to produce to ensure success? And again, we've got a lot of experience in this. We can help you with that type of information and ensure that you've got accurate cash flows at the back of that, and obviously that your business plans are as accurate as possible. And again, have you budgeted for maintenance costs and also unexpected downtime? As good as everyone's equipment is these days, over the years, I mean, the technology that we've got and how this equipment's manufactured and built is absolutely first class. But there might be times when you will be down, and I think it's it's important that people factor that in to any calculations that they're making. So in terms of ROI, can we, I've touched on before, sometimes you need more staff. It could be that, there is a option to reduce or maintain staff levels while still improving cash flow. Something to think about. It's really one of the main key drivers for your ROI. Again, power savings. A lot of the equipment out there, especially ours, we look at how we can impact and help savings in terms of operational costs. Power is a massive cost to any business in waste at the moment, whether that's through fuel, diesel, or through electricity. And all our equipment has been manufactured to ensure that those power savings are as high as we can make them. And as I said before, keep on touching on it, but massively important, that increase in production. What returns will the equipment that you're purchasing allow you to increase your production and then also your cash flow? And lower planned and unplanned maintenance costs. As I say, it's massively important that we're providing equipment and as well as other suppliers, can ensure that those costs are as low as possible, and those costs are spread as evenly across your cash flows we can possibly help with. So thanks a lot for that. I know that was quite a high level and quickly presentation, but again, it's we've got a lot of experience in this area, and in terms of new schemes or existing schemes, we can help, and all our guys can help to provide that information for you to ensure that those projects are successful. And I'm sure that we've got the Q&A session coming now. If I understand some people might not want to hang around for that. If you're one of them, thank you for attending. And yeah, obviously we will ensure that the presentations are distributed to everyone. So if you have any questions after the webinar and would like to contact any of the presenters directly, please feel free to do so.
Thank you, Marcus.
Thanks.
So we have had a few questions come in from delegates today. So I'm going to open the floor up, so to speak, to each of the three presenters today. Some of the questions are targeted at individual speakers. So Oliver, I'm coming to you first, if that's all right. So we've got a question here from someone who has heard that invoice discounting is typically expensive and quite admin intensive. Is that the case?
In short, no. Is the honest answer. So price-wise, typically an invoice discounting facility will be cheaper than, say, an overdraft facility. And like I touched on before, why that is essentially the bank has more, I suppose, more control. It's a more structured product because we're funding against the invoices. So typically the cost of an invoice discounting facility will be cheaper. From an admin point of view, yes, there's more admin involved than, say, an overdraft facility, whereby you might just send your management accounts to the bank. So you upload invoices, but you upload the invoice totals rather than individual invoices. So that is depending on which business the business needs. So some businesses might do that every day if they want to draw down on the facility every day, or some businesses might do it once a week at the end of every week. And then you do a month-end reconciliation with the bank, which basically, so you're working out what the actual the ledger balance is to cross-reference that to the funding. So no is the short answer.
Thank you. Liam, we've got a question next for you, if that's all right. There's a couple actually on the theme of cash flow, but one for you first, Liam. So we've got a delegate here who is considering buying some equipment. They're a little concerned, though, about cash flow not supporting the deposit requirement. So do you have anything to add to that query?
Yeah, I mean, normally ignoring civils for the time being, what we'd look to do, say you were buying, I don't know, materials recycling facility, something like that. I mean, asset finance lenders don't, sometimes will struggle with those sort of things and ask for a bigger deposit. But what you can do, say you had, I don't know, loading shovel or a baler, something like that in your yards, we could actually take a charge over that and raise enough cash to pay for the deposit and possibly the VAT as well. So effectively, you could have what you're looking at buying, without having to release much cash at the front end, obviously protecting your cash flow as well. But with civils, we do get the government backing, so it is a bit of an easier underwrite for us guys. So it may be worth looking at that scheme as well if you're eligible. That might help you get the deal over the line.
Fantastic. And sticking with you, Liam, if that's okay, do Close Brothers insist on certain insurance coverage of assets with specific suppliers?
Not with specific suppliers. Over 250 grand, we do have to have a copy of the insurance letter. But up to 250, we don't know. Obviously, we prefer assets to be insured because they do need protecting. But yeah, not necessarily, no.
Okay, lovely. Another question here, how long does it typically take to secure a finance application? I'm not sure who wants to answer that one first.
I'll go. It depends on the facility that you're looking for. I mean, say for an UNTHA shredder, we're used to financing those. So, depending on the business, we could have you an answer, hopefully same day, but we usually say sort of 48 hours.
Fantastic. Oliver, do you have anything to add to that, or has Liam covered it?
Yeah, so completely agree with what Liam's saying. So it really depends on the type of funding. I suppose the extra moving factor, say from the bank's point of view, is whether you're an existing customer or not. Obviously, if you're not an existing customer, it's going to take longer because we have to go through sort of identification processes sort of in the background. But yes, it really depends on the facility type, which I know is me sitting on the fence a little bit, but yeah, it depends on the type of funding, really.
Okay, thank you. We've got someone else who has a cash flow related question, but they've actually said that they usually pay for assets in cash, and it's actually conversations with their peers that have prompted them to think about financing the asset. So I suppose what they're asking here is whether there's an incentive to go down the finance route at the moment. I don't know who wants to take that one.
Yeah, I'll do it. I mean, the obvious incentive at the minute is a civil scheme, so you get first 12 months without having to pay any interest or documentation fees, anything like that. But it's just the obvious benefits, really. So say you've already bought it, we could refinance it, put the cash in your bank, which could be used for other things. Or, you know, if you, for instance, again, if you buy an UNTHA shredder, you know, we can just fund that direct, and you instead of having to pay all of that out of your bank account at the front end, you know, you pay it. You could even do it over a short term, say 24 months or something like that, which obviously reduces the overall interest.
Okay, thank you. Anyone else, anything to add to that?
Yeah,
Yeah,
I mean,
yeah,
sorry.
Go ahead, Joe.
No, just saying, for me, from a perspective of, you know, I think it's not one size fits all with cash. I mean, obviously, you know, there is certain points where, you know, yeah, you would want to pay cash out, but you know, typically, I think people have you know, they think cash is free, and obviously, you know, at all times, cash does have a cost to the business. When you take cash out the business, you know, it can have an impact. You know, obviously that varies from business to business, and you know, by financing, it does allow to you know, measure against the success of the project, and it also ensures that, you know, you're using that cash to you know, fund typically other projects which might not be revenue generating at that point. So you know, there's not a one size fits all in terms of how, you know, you would fund that. And sometimes, you know, even though you've used cash historically, it might not be the best fit for the project at the time that you're looking at in terms of ROI, as we touched on before.
Thank you, Marcus. Any other comments from anyone else?
I was just going to say, given where base rate is at the moment, obviously it's 0.1%. So although cost of funds in the background, it has gone up over the last couple of months, base rate being where it is, that's another advantage. And it has been low for a sustained period now. So the actual cost of borrowing compared to 10 years ago is, it's obviously, it's not free, but it is a lot lower, so it gives you that other opportunity, really.
Thank you. Oliver, I'll fire this question at you. From start to finish, how long should it typically take for a customer to get a CBILS approval?
Okay, so start to finish, I've done them within a week, start to finish. So that's from getting the first information, going through our credit process, getting the money into your bank account. Bear in mind that's up to £5 million. So it's in my opinion, it feels quite quick. You may disagree, but yeah, within a week you could get there. Typically, a week to 2 weeks might be the norm normally. But yeah, so we recognise within the banking industry that this money is required urgently normally. You're applying for a particular reason, so we need to get it to you. It's no good having it approved in the background without actually putting it into your bank account.
Okay, thank you. Marcus, there's a question here from someone looking at potentially a small recycling line. They are interested to know if you offer help with building the business case and making the finance application, if it's a comparatively smaller investment than some of the plants that UNTHA may supply.
Yeah, great question. I mean, yeah, we, you know, as a business, whether you're buying one of our smaller products or, you know, a very simple processing line, or, you know, one of our big waste shredders, the process is the same. You know, the information that we provide is exactly the same in the process. How we help our customers to get the finance and get the application through wouldn't be any different. So the answer is that yes, we would assist. We provide all the information, and I think especially in terms of Liam could confirm that a lot of these applications that we do in terms of buying an UNTHA product and conveyors, magnets, those type of simple systems that we sell a lot of, it makes it a lot easier. And when Liam gets those type of applications through, we're able to turn them around quite quickly because the information is provided at the front end before that application goes over to underwriting.
Thank you, Marcus. We've got one final question, unless anyone wants to post any final ones, and then I will thank everyone for attending and wrap up. The final question is whether asset-based lending is set to become more popular given the current economic climate. Liam, I'll fire that one to you to begin with.
It's a good question, difficult to answer, to be fair. I'd assume it is going to, definitely. I think there's a lot of businesses out there which have got, a lot of money tied up in assets outside, and, times may be tough going forward. So, at least you've got that safety net there, that the cash is in that asset and we're able to release it, So I think refinancing is probably going to become a lot more popular. We've seen quite a big increase in it since March for obvious reasons. Yeah.
Thank you. Oliver, do you have anything to add?
So just to echo in Liam's point, so I agree. I think there'll be more refinancing coming up, and more of the sort of opportunities where businesses are thinking, actually, normally we'd buy it out of cash, but shall we start to look to fund it one way or another? And I'm starting to see that coming through now from my customers. So yeah, just echoing Liam's point there.
Thank you very much. So thank you all for attending. I'm going to hand over to Marcus just to close. Just to confirm, as he said earlier, you will all receive a copy of the slides today, and in fact you'll receive a recorded session of the entire webinar so you can listen again at your own convenience. The gentleman's contact details are on screen if you wish to get in touch with them to ask any specific questions you'd rather ask on a one-to-one basis. But other than that, I will hand over to Marcus to close. Thank you very much.
Yeah, thanks very much, Katie. Thank you everyone for attending this morning. Really pleased that we were able to just give some of our knowledge to you. And as Katie started, it's not about a sales pitch. We like to inform our customer base and help. Just not in today, but in the future. So all the stuff that we've spoken about over, and Liam and Oliver have touched on, these are things that we're doing every single day, and we've got a lot of experience here. And I'm pretty sure that not just myself, but everyone in the UNTHA team and Liam and Oliver would be more than happy to answer any questions that you may have after the webinar's finished. And just get in touch. I mean, that's what it's about. And sharing that information and helping each other through what is a very difficult period, I think is massively important to ensure that we all prosper through this difficult time. So again, thank you for attending, and just say hope to see you next time at the next webinar.
Thank you, everyone.